Have you ever wondered how some people slowly grow their money without starting a business or stressing over the stock market every day? What if there was a way to build wealth that didn't require chasing risky stocks or jumping on the next crypto trend? Here's the truth. Millions of everyday people, teachers, drivers, even students, are using a simple method to grow their money over time. Their secret: index funds. It might sound boring, but it's one of the smartest ways to create passive income and build long-term wealth. Even if you're not rich or a money expert, with just a little knowledge, a clear plan, and maybe even $100 to start, you can begin your own journey. So how do index funds work? Which ones are best for beginners? And how can you start today? Stick around, hit that like button, and subscribe for smart, simple tips to grow your money without the stress. Starting your journey toward passive income. If you're looking for a simple, low-stress way to grow your money, index investing is a great place to start. You don't have to guess which stocks will win or spend hours watching the market. With index funds, you're investing in a group of top companies all at once. That means your money is spread out, which lowers your risk and helps you grow your wealth over time. It's one of the smartest passive income strategies out there. Even Warren Buffett, one of the richest investors in the world, says that low-cost index funds are the best choice for most people. Why? Because they're easy to use, don't cost much, and don't need your full attention. You don't need to be a stock expert. You just invest, hold on, and give it time. Over the years, your money can grow while you focus on living your life. Simple, smart, and stress-free. What is an index fund? Let's break it down in the simplest way. A stock is just a small piece of a company. If you buy one share of Apple, you now own a tiny part of Apple. If the company does well, the value of your stock usually goes up. If it has problems, your stock might go down. It's that simple, but also a bit risky if you only own one company. That's where index funds make things much easier and safer. An index fund is like a basket filled with many different company stocks. Instead of putting all your money into one business, you're spreading it across many. One of the most popular index funds follows something called the S&P 500. This includes 500 of the biggest and strongest companies in the US, like Apple, Google, and Amazon. So when you invest in an S&P 500 index fund, like Schwab's SWPPX or Vanguard's VFIX, you're buying a small piece of all those companies at the same time. This helps lower your risk and gives you a better chance to grow your money over time. There are also total market index funds, like VTSX, which let you invest in almost the entire US stock market, giving you even more safety through diversification. How index funds work. Here's how it works in simple terms. When you invest in an index fund that follows something like the S&P 500, the value of your investment goes up or down depending on how that group of companies is doing. So if the S&P 500 goes up by 1%, your fund will likely go up by about the same. If it goes down, your fund might drop too. It's pretty simple. Now here's the good news. Over the last several decades, the US stock market has grown by about 10% each year on average. That doesn't mean every year is great. Some years go down. But over time, the market has always recovered and grown even more. So if you invest in a low-cost index fund and give it time, even a small amount, like $100, can grow into much more. The key is staying patient and not pulling your money out when the market dips. It's not about getting rich overnight. It's about slowly building your wealth while you let time and growth do the hard work for you. Why people love index funds. Pros. So why do people trust index funds so much, especially for long-term wealth building? Here are the big reasons. 1. Less risk through diversification. You're not putting all your money into just one company. Instead, you're spreading it across many. So if one company does badly, others might do well, and that helps keep your money more steady and balanced. 2. Steady growth over time. Index funds won't make you rich overnight. But if you keep investing regularly and give it time, your money can grow a lot. That's the power of compounding. Your money earns more money as time goes on. 3. True passive income strategy. You don't need to check charts or study company news. You simply buy, hold, and let your money grow on its own in the background. It works while you go on with your day. 4. Low fees. Low-cost index funds, like those from Schwab, Fidelity, and Vanguard, often have expense ratios as low as 0.02%. That's just $2 a year for every $10,000 invested. The downsides of index funds. Cons. While index investing is great, it's not perfect. Here's what to keep in mind. 1. You won't beat the market. Index funds are designed to match the market, not beat it. That means your returns will be average. If you're looking for a quick 700% gain like Tesla once gave, this isn't it. 2. It takes time. This is a long-term wealth building method. It could take 10, 20, or even 30 years to see big results. But the good news, time is your best friend when investing. 3. It can feel boring. There's no daily thrill, no fast wins. But sometimes boring is what builds real success. Best index funds for beginners. If you're just starting out, here are some top choices to consider. Schwab S&P 500 Index Fund. SWPPX. Low fees, no minimum. Vanguard Total Stock Market Index Fund, VTSAX, covers the full market. Fidelity Zero Total Market Index Fund, 𝐸𝐶𝐷, zero expense ratio. Target date funds. These adjust automatically as you get older, perfect for retirement planning. Dividend-paying index funds, like Vanguard High Dividend Yield, VHYAX. These give you regular cash payouts while still growing. These are all great options if you're asking what's the best index fund for beginners. How to pick the right index fund. Now let's break down how to choose the best fund for you. Here's what to look at. 1. Minimum investment. Some index funds are easy to start with, even if you don't have much money. For example, Schwab's SWPX lets you begin with just $1, while Vanguard's VTSAX may need $3,000. If you're looking to start investing with $100, Schwab or Fidelity are great options for beginners, because they offer low-cost funds with low or no minimums. 2. Transaction fees. If you're buying a Schwab fund, it's best to do it on Schwab's own website. Same goes for Vanguard funds. Buy them through Vanguard. This way you avoid extra fees or charges that can come from using the wrong platform. It's a simple move that saves you money. 3. Expense ratio. This is the small fee the fund takes each year to manage your money. To keep more of your money, look for low-cost index funds with an expense ratio under 0.05%. It may not seem like much, but over time it makes a big difference. 4. ETF, or mutual fund. ETFs move up and down all day like regular stocks, while mutual funds only trade once a day at the end. If you're just starting out, mutual funds are the easier and simpler choice. Opening a brokerage account. To buy your first index fund, you'll need a brokerage account. This is where your investments will live. Here are 3 top choices. Charles Schwab, great for beginners. Low fees. Vanguard, known for their low-cost index funds. Fidelity, also beginner-friendly and offers no minimum options. Visit their websites, create an account, enter your info, link your bank account, and you're ready to invest. Step by step, how to buy an index fund. Let's say you're using Schwab. Here's how to do it. Log into your Schwab account. Go to All-in-One Trade Ticket. Pick your account, like a Roth IRA, or individual account. Type the fund ticker, for example, SWPX. Click Buy. Enter how much you want to invest, even just $100. Choose whether to reinvest dividends. Click Place Order. That's it. You now own part of the S&P 500 and have officially started your journey toward passive income and long-term wealth building. When should you sell your index fund? So, when should you sell your index fund? The simple answer, almost never. The whole point of index investing is to grow your money slowly over time. It's a long-term game. You should only sell if you really need the money, like when you're retiring or facing a serious emergency. A lot of people panic when the stock market drops. They get scared and want to sell before losing more. But that's usually a mistake. History shows that the market always goes up and down. That's normal, and most of the time it bounces back even stronger. If you sell too soon, you might miss out on the big gains that come after the drop. So what's the best strategy? Buy, hold, repeat. Let your money sit and grow. Give it years, not weeks. Trust the process. Be patient. In the end, time is your best friend when it comes to growing wealth. So what are you waiting for? Index funds are one of the easiest and safest ways to grow your money over time. You don't have to be rich. You don't need a fancy degree. All you need is the courage to start, even with just $100. Will you look back in 10 years and wish you had started today? Or will you thank yourself for taking that first step? Whether you go with a total market index fund, a dividend-paying index fund, or a target date fund, the important part is getting started. It's not about being perfect, it's about being consistent. Remember, the best time to invest was yesterday, but the second best time, right now. If this video helped you understand index funds a little better, give it a like, subscribe to the channel, and turn on the bell so you never miss a tip. Let's grow your money together, one smart step at a time.